Aaron, what was the market and OC focused on coming into reporting season?
Well, thanks for having us, Maddie. I think before we head into reporting season, it's important to contextualize where we're at in the world. I think at a macro level, that certainly has dominated a lot of our thinking. We've had, unprecedentedly high levels of inflation globally, an uncertain geopolitical environment, particularly in Ukraine and Russia, which has had impacts on markets such as, the energy markets. And in response to all of this, we've also had, central banks around the world tightening, raising interest rates. And from our point of view, certainly there will be ramifications on, everyday consumers and also the businesses that we're investing in. If you then, look to markets, markets certainly have reflected a lot of this. Valuations have come off, but hit into reporting season, we did take a more cautious view, given we hadn't really seen a lot of the macro effects flow through into company profitability, and also into forward-looking expectations around company forecasts.
Can you outline some of the key takeouts from reporting season?
Yeah, well, given that backdrop, it was important to note that results were typically not as bad as expected. For example, in the consumer discretionary space, companies such as Universal Stores, Baby Bunting, Viva Leisure all reported pretty solid trading updates for July and August. Furthermore, consumer lenders such as Money3 and Credit Corp still reported that customers are generally paying their loans on time. This is because the economy is still fundamentally strong, unemployment is very low, customers are getting wage rises, and they're still out there at the shop spending money. Uh, Other examples which may not have been as strong include e-commerce, which is, after a year of being locked down in FY21, finding it harder to kind of retain the same levels of customer growth in FY23. New Zealand is also doing it slightly tougher. This could either be because they're further advanced down the tightening cycle, or it could be factors pertinent to New Zealand. So what we're seeing is that the economy is still going well and that interest rate rises haven't had an impact yet. However, we think that this could potentially flow through around Christmas or in the second half of fiscal 23 and calendar year 23. And for these reasons, not many companies actually gave guidance this year. In fact, I probably only came across about 20 companies which issued guidance for FY23. And typically, these are companies which have high recurring revenue, very high customer retention, with products that are not sensitive to the economic cycle. Examples include insurance brokers, health services, and also software names. In our portfolio, these included stocks like PSC Insurance, Monash IVF, and Trajan Scientific.
In addition to Dan's comments, I'd actually highlight there were a couple of themes that really stood out to us. The major one really was around the labor piece, both in terms of labor shortages and wage increases. We've been locked down for the last 2 years. It's been hard to travel. And really what we've seen is there hasn't been any net migration of skilled labor. And that's made it hard for companies, looking to hire new people, and also, retain the people that they have. In addition to this, we've seen, mandated wage increases. Companies I'd call out would be, Aussie Broadband and Symbio, both in the micro cap space, have called out an 8% increase in wages for the next fiscal year, which is, quite substantial. I think on that labor piece as well, it's interesting to observe what companies are doing to try and retain talent outside of just paying them more. An example would be Mineral Resources, which is a company we own within the Premium Small Companies Fund. They built a new head office in Perth, and it comes with a whole range of different amenities, from staff cafeteria, gymnasium, even a childcare centre. So they're making it more attractive, a place for potential employees. So some of these soft touches are quite unique. Interestingly as well, we're seeing a number of themes, which have been present over the last 2 years persist, such as supply chain issues, and absenteeism in the labor force. On the supply chain side, the sort of delays around the delivery of capital goods, such as new cars and computers, that's continued to persist. But where we've actually seen supply chains improve is around the freight side. companies have called out, freight prices having peaked and expectations that they start to come off as well. I would say though, heading into what might be a softer macro environment though, it's pleasing to note that many of the companies we look at are in strong positions with regards to their balance sheets, and are well placed from that perspective. We've actually seen, a few companies with strong balance sheets conduct share buybacks over the last, reporting season. Companies such as Ridley and Omni Bridgeway, for instance, announced share buybacks, and these were both reasonably well accepted by the market.
Finally, Dan, where is OC currently finding opportunities?
Yeah, today, given all of these themes that we've been noticing, we're very focused on cash generative businesses with defensive products, healthy balance sheets, and valuation support. Some examples include Bapcor, which is a distributor of car parts for second-hand cars, and ProBiotech, which is a contract manufacturer with long-dated customer relationships. We're a little bit cautious on consumer discretionary side, given likely softening macro into calendar year 23. We remain selective and sort of largely sitting on the sidelines. We think the opportunity in that space will be when interest rates and inflation stabilizes. Furthermore, we have a similar view on longer dated growth companies with high valuations. We think that if interest rates increase further than expected by the market, then that sector is at risk of derating. However, the converse is also true, and furthermore, private equity has become very active in the space, bidding for tech names such as Nitro Software, Nearmap, and also Tyro. So overall, we're fairly defensively positioned and we have a healthy cash balance.
Thank you both for those insights. Should you have any questions relating to the OC funds, please contact your Copia Business Development contact. Thank you.